Hey guys, what's up? Welcome back to The Impeccable Investor. If you're an investor looking for a quick way to boost your investments, you may want to look at the funds. But how are you going to decide between exchange trade funds and mutual funds? The truth is that there is a lot in common between ETFs and mutual funds. However, some vital distinctions could make one of them a better choice for you than the other. We'll be discussing the similarity and differences between both methods in this video, and how to assess which of the two methods is best for you. Similarities between ETFs and mutual funds. The ETFs and the mutual funds can be somewhat identical. Both pool investor money for the stock acquisition, and the fund manager regulates the portfolio to ensure that it meets its investment goals. Both of the products may follow the market index or seek to outperform the market. Investors pay a portion of their investments to each fund service. This is called the expense ratio, and both the ETFs and the mutual funds allow you to own shares of a wide variety of companies without having to buy each stock yourself. Fund managers are responsible for rebalancing the portfolio to make sure that the fund reaches its investment objective. The investment objective of the fund could be to allow a stock index such as the S&P 500. These funds are referred to as index funds and are a subset of ETFs and mutual funds. Index funds are sometimes referred to as passively managed funds because the fund manager does not make decisions about what stocks to buy. Instead, the manager's job is simply to reorient the portfolio when the benchmark index changes and to manage the cash inflows and outflows of investors. Many of the funds are actively controlled. Actively managed funds' aim is to surpass the benchmark index by buying and selling stocks built on the research of the fund manager. Actively managed mutual funds are much more popular than actively managed ETFs. Index funds typically have very low expense ratios, while actively managed funds have higher expense ratios. Differences between ETFs and mutual funds. The differences between ETFs and mutual funds can have major consequences for investors. One major difference to recognize is how the shares of the funds are priced. Because ETFs are bought and sold on an exchange basis, market factors determine the value of the fund itself. When there is a significant demand for the investment, the underlying value of the securities issued by the investment may be valued higher than its net asset value. The opposite is also true. If there is a sudden rush to sell the shares of that particular fund, it could be priced below the net value of the asset. Usually, this is not a problem for most ETFs with high liquidity. By contrast, mutual funds are often valued at their net asset value at the end of each trading day. Tax output is another significant factor. ETFs are typically more tax efficient than mutual funds because ETFs are exchanged on an exchange instead of being sold by a mutual fund firm. There is a buyer for each sale. It might not be the case for a mutual fund because a lot of sellers may force the mutual fund firm to sell the underlying securities. It would have tax consequences on capital gains for all investors, regardless of what they sell. Other differences, such as the right to buy fractional shares, fees, and minimum investments, will vary depending on the funds and dealers you are choosing, which is right for you. Understanding the differences between ETFs and mutual funds can help you decide which is best for you. Use ETFs if tax efficiency is very important to you. If you invest in a taxable brokerage account, having more control over the distribution of capital gains may be a decisive factor. When you invest in a tax-advantaged retirement plan, tax flexibility is a crucial factor. You can go for ETFs if you're a very good dealer. You want to set limit orders and stop limit orders, or use a margin in your investment strategies. You can choose ETFs if you want to gain low-cost access to a particular market niche without exploring individual companies. In the future, you can change brokers. ETFs are quickly exchanged between brokers, but you typically need to close mutual fund positions before changing brokers. You will then have to reinvest the profits in the mutual funds provided by your new broker. Use mutual funds if a similar ETF that you are considering is less traded. Reduced liquidity for an ETF may result in large spreads of bid/ask. often allowing you to pay a premium over the net asset value of the fund. Mutual funds are always valued at net asset value. Opt for mutual funds if by active management, you value the opportunity to outperform the market. Most ETFs are index funds that essentially suit market returns. You need active management to outperform an index. Keep in mind, however, that these funds typically have higher fees and higher tax ramifications, and you're not guaranteed to be outscoring even with active management. If you're investing in less competitive areas of the market, mutual funds can be your go-to. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss out on any of our videos in the future. Also watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.